Hi, Karim Rahemtulla with Frank Holmes, CIO and CEO of U.S. Global Investors. Frank and I go back a long way, and this is really interesting because Frank is very involved in what goes on in the financial markets, especially currencies, precious metals. You've got funds that manage these different investments, and you see the inflows and the outflows. What are you seeing now about gold? Does this run for real?
It's a great question, because I just wrote a piece on this and I was so surprised myself that this past quarter we saw an incredible run in bullion. In fact, the best quarter in 30 years of data points. And what the data shows is that every $1 billion that goes into the GLD, gold goes up $30. However, the GDX and the GDXJ, the gold equities, had net redemptions.
Net redemption, the price of stocks still went up, even though there's net
They went up between 34 and 45%, and it didn't matter. People don't believe. And this reminds me back of 2001, 2002, when gold first went from $300 to $400 range. No one believed. And I think that that's the scenario we're in now.
The initial stages of another bull market, maybe.
I would think so, because I think this whole thesis on negative interest rates to stimulate global economic activity is really grabbing at the heart of all these policymakers.
So if this gold run doesn't appear, it appears that people don't have faith in the run in gold right now. As you said, you saw this happen in the 80s, but the negative interest rates, that's got to be a positive, right, for people?
It's a huge positive. I've written about this extensively, called the fear trade. There's two moves that make gold move, and it's the love trade, which is a rising GDP per capita out of China, India, the Middle East. There's a natural proclivity to buy gold for gift giving. The other big part of the equation is fear trade, and the fear trade is negative interest rates. And our research has shown that whenever a country's currency is offering their citizens a negative rate of return, that is, what will they pay you on a 2-year or money market fund or a 5-year government bond, take away the monthly CPI number. If it's negative, gold rises in that country's currency. So the U.S., when gold hit 1900 in September of 2011, the 10-year government bond was minus 3%. You locked in a negative rate of return. Since then, it's gone plus 200 basis points. And now we're starting to see it back to negative. So that's why gold's rallying.
But, people who invest in gold are ever optimistic. Gold is always going to go higher, and wouldn't you know it, that it's good for about 3 or 4 years. People make a lot of money. It's not like they don't make any money. They make a ton of money. But then it comes down, and everybody is so depressed because they thought this was it. The gold bugs and gold investors, this is always it. So is this it this time?
Well, I think there's gold bugs and there's gold investors. I differentiate that. The gold bug is always a fanatic for every reason, but the gold investor understands, and I've written about this also, rebalancing every year and every quarter. So that when you get these incredible runs, you take some profits off the table and buy bonds, or you buy another asset class, and when they surge, because it's not straight up. And there's tremendous volatility. The DNA volatility of gold is plus or minus 20%, 70% of the time over any rolling 12-month period. Gold stocks is 40%. So whenever you get these 40% runs in gold stocks for 12 months and 80% runs, you better take some profits. And I think that's what gold investors do.
Well, right now, a lot of gold stocks are up 40%, some are 60%. You were talking about South African gold companies
Absolutely.
that are up over 100% because of the currency. Is it time to take some money off the table?
I think that if you came in at the beginning of the year, yes. But what's so interesting is that from a year ago, most of those gold equity ETFs are flat or still negative.
Right.
So they fell so much that this is the first surge coming out of that bottom.
Okay, so now, beyond the dollar, we deal with currencies as well as commodities, as well as international stocks, and domestic stocks have international exposure. But you have a unique take on currencies. You figured out what commodity affects what currency in what country. Can you give us a rundown?
Well, what really surprised me the most was Norway. Norway has about 8 million people with $1 trillion of savings, but their currency moves at the price of oil. So oil's down, the Norwegian krona is going down. Okay. Canada is oil. When we look at Australia, it's iron ore. Iron ore also impacts Brazil, but much more significant the impact on what's taking place in Australia. Now when we go look at Peru and Chile, it's copper prices. The price of oil was falling, which is good for gold producers because they have margin expansion. Right, the Canadian dollar is falling, so their labor is getting better, and the price of gold just has to rally 5%, and all of a sudden they have huge margin expansion. What can wipe that out? The falling currency. So that's what we did on a rolling basis.
Now, do you think that for the first time, maybe in history, that the major gold producers and maybe even some of the junior ones are actually going to show a profit, a financial profit. You know, when we had gold prices of $300 an ounce, it was still hard pressed to find gold companies that were like making a profit. Then they went up to 1900 and they went out there and started buying all these other mines, and their costs went up like crazy, and they still failed to show any significant profit. You know, there's always been this equation that if the price of gold is $12.50 and your all-in cost is $900, you should show
A profit.
a profit, and that just doesn't seem to happen. Why is that?
They just grew for the sake of growth.
Okay.
One of the things we look at is cash flow return on invested capital. And what you saw, there was about 3 years that these gold mining companies from 2003 to 2006 had higher cash flow returns on their capital than the S&P 500. That was the big surge they had. Then they started buying everyone and buying everything, and they destroyed that model. But what has been most consistent has been the royalty companies. And my favorite has been Franco-Nevada. Franco-Nevada has 22 employees, and it has revenue of $15 million per employee. Goldman Sachs is $1 million. They have high gross margins, high returns, and all they do is buy royalties on these mines. So why buy Barrick and why buy Newmont? You buy Franco-Nevada, and you don't have to worry about tractors and union problems,
There's
et
no
cetera.
overhead.
They have a royalty on all Nevada. So I think that's a cleaner way to play that. And in the past 5 years, when the gold equity ETFs are off 50% still, even with this big rally, the Franco-Nevada's doubled.
Yeah, Franco's up. It's very strong. Franco, Royal Gold, all these royalty companies that are substantial
Correct.
assets.
So that's a safer way to play it.
Now, as far as the U.S. dollar, that's one of our big, focuses beyond the dollar. Our contention is that we're in the middle of a dollar rally that's unsustainable. That it's in the best interest of the U.S. to have a weaker dollar. It's good for exports. It's good for just about everything. And the reason the dollar is so strong now isn't so much because of the fundamentals in the U.S. It's because other countries have devalued their currency so massively. Do you share that thesis? Do you share that we're in the middle of a dollar bull market and this is a chance to now exchange your strong dollars for hard assets that are cheaper? Or do you think the dollar is going to get stronger?
I think the dollar is probably going to get weaker because we're going to see, for several factors. One of the biggest things is we've been all fooled by this. Before, going back 20 years ago, 10 years ago, we focused on what's called nominal interest rates. What are they paying in the bank? And interest rates, if they went from 8% down to 5%, is easy to see. But really, money flows and gold flows to real interest rates. What will the government pay you minus that monthly CPI number? If it's positive, negative, that's the key factor. So we had zero Fed fund rates for all these years. But what happened from 2011 of minus 3% real interest rates to plus 2 was we never saw it because Fed funds everyone focused on was zero.
Right.
But the U.S. experienced the highest, whenever you've had a 500 basis point swing in real rates, emerging markets get clobbered, the U.S. dollar gets too strong, and I think that big mean reversion is now in place you're talking about.
Yeah, I think so too. Thank you very much, Frank. It's always great to talk to you.
It's great to be here.